Hey, it's Lon Welsh at Your Castle Real Estate. I've got Joe Massey, our in-house lender today, to be our expert about what's going on in the mortgage market. And as mortgage rates have gone up, I'm hearing from consumers and agents very frequently that they're thinking about adjustable rate mortgages as maybe a way to manage their payment. I know there's a lot of pros and cons to ARMs. Can you help us understand what you might want to think about as a buyer?
Yeah, absolutely. So, a fixed rate is pretty easy to understand. You get a fixed interest rate of, let's call it 6.75%, and it's the same for the next 30 years. An adjustable rate, there's various terms. Maybe it is fixed for the first 3 years, 5 years, 7 years, or 10 years, and then begins to change after that. Well, if a fixed rate is at 6.75, in practice, an adjustable rate would be something lower than that because it's going to be fixed for a shorter period and then change. Right now, the difference between those two is not very much. It's only about 0.5%. So fixed interest rates are 6.75, and adjustable is going to be between 6.25% and 6.5%.
Really close. Okay.
So it's not a big variable between the two. And so what you see is, yes, you could select an adjustable rate of 6.25, and maybe your payment is going to be lower by $150. Maybe it's $200. It depends. But then at some point in the future, maybe in year 4 or year 6, that payment is going to adjust. Now, a lot of folks say, hey, I'm going to get an adjustable rate because I'm going to refinance in the future. Well, generally, what's the reason you would want to refinance?
The rates went down.
Because you want a lower interest rate, right? So we're going to get this adjustable rate, and then in the future, at year number 6, my rate's going to adjust. But if interest rates have gone up, guess what? Your interest rate's going to go up. Okay? And the reason you get an ARM is you say, hey, I'm going to refinance at some point in the future. But if you're wrong and interest rates haven't gone down,
now you're stuck.
You're stuck at what is now going to be a higher interest rate. And the first adjustment on an adjustable rate can be up to 5%. So if you start at 6.25, 5 years later, it's a first adjustment and interest rates have gone up, your rate could adjust from 6.5 to 11.5.
Wow.
That nearly doubles your mortgage payment. And that's one of the things that caused the financial crisis in 2008.
Right.
So folks looking at an adjustable rate, they're good for some people. They're not good for others. It's something that we review with many of our clients, but I'm pretty conservative. And the last point I'll tell you about adjustable rates is they're not inflation protected.
Okay.
What I mean by that is inflation is a big word that we hear right now. A 30-year fixed rate loan is never going to change with inflation. Okay.
Right. So if we endure having a high inflation for a long time, you've already locked it in.
That's right.
So in constant dollars, like your payment's actually going down every year.
That's exactly right. Whereas an ARM is not inflation protected. It's going to go up associated with inflation.
Right.
So right now, when everybody's concerned about inflation, why would you buy something that's subject to future inflation? Wouldn't it make sense to buy something that is inflation protected and, as you said, in future dollars is actually decreasing?
It makes a ton of sense.
Yeah.
Thank you for helping us to understand this.
Absolutely. If you guys want to talk more, you have individual clients that have questions, or you disagree and you think ARMs are great, we'd love to hear about that too. Call, text, email. We'd always be happy to chat.